Hey everyone, Amy here. So glad you're joining us.
I'm Tom. Yeah, good to be here. We're excited to guide you through today's fascinating economic currents.
We've got a fresh stack of insights from July 1, 2025, a pretty comprehensive look at what's been moving global markets.
Hmm.
We're talking soaring stock indices, shifts in central bank policies, and, the political debates influencing it all.
Right.
Our mission today is really to unpack these sources, pull out the most important nuggets of knowledge, and give you a shortcut to being genuinely well informed.
It's a truly dynamic period in the financial world, no doubt. And we're going to try and connect the dots on what happened yesterday and what's actively driving the narratives today. Let's jump right in.
Okay, let's unpack this incredible run we're seeing. I mean, the U.S. market. On Monday, July 1st, both the S&P 500 and the Nasdaq Composite hit new highs again.
Again, yeah.
And the S&P 500 even powered past the 6,200 milestone. What does this extraordinary performance tell us about maybe investor sentiment right now, especially after a quarter that started with some real jitters?
What's truly fascinating here is the sheer resilience, right? The S&P 500 just closed its best quarter since, December 2023,
Ah,
advancing a remarkable 10.57% during Q2. And this followed a noticeably volatile three-month period. We saw that significant market drawdown, mostly due to those trade tensions. So to rebound so strong, I mean, you're completely shrugging off that volatility, it speaks to a deeply entrenched optimism. You have to think it's particularly fueled by the relentless climb of technology shares.
right, tech leading the way.
It's almost as if investors are rapidly deploying capital on any dip. It signals a fundamental belief in long-term growth, especially,
Right.
within that tech innovation sphere,
Yep.
even with broader economic uncertainties hanging around.
That's a crucial point, the buy the dip mentality. It seems really strong. And within that broad strength, we definitely saw clear sector winners and, well, some areas that didn't quite keep pace.
Yeah.
Information technology was the star, up nearly 1% overall. And Hewlett-Packard Enterprise specifically rallied, what was it, an impressive 11.08%.
Huge jump for them.
Huge. But on the flip side, consumer discretionary was the laggard, down almost a full percent. And you had big names in there like Tesla and Amazon seeing declines.
Yeah, pulling it down.
So this makes me wonder, beyond the broad sector moves, what were the specific corporate stories? What really moved the needle for some of these individual companies?
Absolutely. And this is where the individual details, they really illustrate the broader picture. Take Boeing, for instance. We learn CFO Brian West is stepping down.
Okay.
Now, he had a really pivotal role in one of the largest capital raises in U.S. corporate history last year, a critical move to stabilize the company, given everything they'd been through. So his departure, especially considering those recent contributions, it kind of signals a new phase for the company. And you can bet the market will be watching very closely for his successor.
Makes sense. A leadership change like that always gets attention.
Then there's Hewlett-Packard Enterprise, which, as you said, just soared. That came after the Justice Department settled its lawsuit, challenging their $13 billion acquisition of Juniper Networks.
Ah, okay. So that explains the jump.
Exactly. This settlement came, less than 2 weeks before the scheduled trial. It removed this massive overhang for HPE,
Right.
allows them to proceed with a really strategic acquisition, solidifying their networking infrastructure business. Huge win. This removes a ton of uncertainty.
That settlement for HP clearly was a major catalyst then. And it wasn't just about litigation moving things. We saw Apple reportedly considering integrating AI from either Anthropic, PBC, or OpenAI for a new Siri, and potentially sidelining its own in-house models. That feels like a pretty profound strategic move, doesn't it?
Oh, definitely.
It almost feels like an acknowledgement that maybe their own efforts aren't scaling fast enough. How does this shift impact their competitive landscape? I mean, especially against companies like Google or Microsoft who've arguably had a head start in AI integration.
It's a very significant pivot for Apple, no question. It reflects the intense pressure, I think, on all the tech giants to deliver cutting-edge AI. And maybe it's just a pragmatic decision, right? Leverage best-in-class external models rather than trying to play catch-up solely with internal development.
Yeah, build versus buy, essentially.
Exactly. It really underscores the competitive intensity in the AI race. And it could accelerate Apple's ability to offer more sophisticated, generative AI features. Could potentially reinvigorate their whole ecosystem.
Interesting. Okay, and elsewhere.
Elsewhere, Moderna announced its experimental flu shot met its primary endpoint in a late-stage trial.
Good news for them.
Yeah, that's a key development for their broader strategy. especially as they explore these combination vaccines like flu and COVID together. That could be a huge market down the road.
So big tech shifts, significant advancements in biotech. But on a less positive note for one company, Nintendo actually withdrew products from Amazon's US website,
Yeah, saw that.
apparently due to a dispute over unauthorized sales. This meant Amazon missed out entirely on the launch of the Switch 2, which has been described as like the largest game console launch in history.
Wow.
That's a huge potential revenue hit for Amazon,
Right.
right? It really highlights the sometimes rocky relationships between these big platforms and their biggest vendors.
Indeed. It shows the power dynamics aren't always one-sided. And another major strategic play happened with Home Depot. They agreed to acquire GMS.
Okay, who are they?
They're a specialty building products distributor. Home Depot's paying $4.3 billion.
So a big deal.
A very big deal. And it's not just another acquisition. It looks like a clear strategic move by Home Depot to really fortify its position against competitors like Lowe's
Hmm.
in that lucrative professional contractor market.
Ah, the pro market. Right.
Yeah, that segment often provides more stable, higher volume sales compared to the more cyclical DIY consumer segment.
Oh.
It signals Home Depot is making a long-term bet on the construction industry's backbone.
So if we kind of connect all these individual threads,
Mm-hmm.
the Boeing CFO change, the HPE settlement, Apple's AI move, Moderna's trial, the Nintendo Amazon spat, Home Depot's big buy,
Mm-hmm.
it really shows how these macro trends we talk about are ultimately influenced by this mosaic of company-specific news.
That's exactly right.
Everything from strategic shifts to major acquisitions, supply chain disputes, even leadership changes. It's just this constant interplay.
Exactly. Each of these stories, while maybe seemingly isolated, contributes significantly to the overall market sentiment sector performance. It reminds you that the aggregate market is truly a sum of its parts.
Okay, so moving beyond U.S. stocks then, let's look at the global stage. A slightly different story unfolded there, it seems. European stock indices like the CAC 40, DAX, FTSE 100, they all saw declines.
Yeah, bit of red across the board there.
But where it gets really interesting, I think, is in commodities and currencies. Gold prices declined. Pretty sharply, actually, over 2 percentage points on Monday. Settled at $3,293.55 an ounce.
Right.
Now, this is intriguing because the US dollar was weakening at the same time, which usually offers support to gold. So why did gold drop when its typical inverse relationship with the dollar suggested it should have maybe held up better or even risen?
That's a critical observation, Amy, and it really highlights a shift in investor priorities, I think. The improved risk sentiment among
Yeah.
investors. It was just significant enough to counteract the typical support from a weaker dollar.
So risk on beat the dollar effect.
Pretty much. When investors feel more confident about the broader economy, they're more willing to take on risk, and they often pivot away from those traditional safe haven assets like gold.
Makes sense.
So, despite the dollar's weakness, the market's overall risk-on mood just pushed gold lower. But even with Monday's drop, it is worth noting gold still appreciated for the second consecutive quarter. It was up, 5.77% in Q2? So it shows it's still very much a part of broader asset allocations.
Okay, that distinction between risk sentiment and just simple currency correlation is important. What about oil? Both WTI and Brent crude decreased slightly. What was driving those movements?
For oil, it looked like investors were kind of weighing two things against each other. On one hand, diminishing geopolitical risks in the Middle East.
Less fear premium.
Exactly, less fear of supply disruptions tends to lower prices. But on the other hand, you have the potential for an output increase from the OPEC Plus alliance coming in August.
Ah, more supply potentially.
Right, so this tug-of-war is key. Less fear, plus the prospect of more oil hitting the market from producers like OPEC plus UCO that naturally adds downward pressure.
And adding to those supply side concerns, didn't U.S. crude oil production actually reach a new high back in April?
It did. 13.47 million barrels per day, a new record.
Wow. Okay, so you combine that record U.S. production with OPEC Plus reportedly poised to increase production by, 411,000 barrels per day in August.
That's the figure being reported, yeah. Following similar increments earlier in the year.
That just sounds like a lot of supply coming online or staying online. Does that imply we could see continued pressure on oil prices in the near term?
It certainly adds a bearish tilt to the outlook, yes.
Okay.
It doesn't guarantee lower prices, but the supply side looks pretty robust right now.
Okay. And on the currency front, you mentioned the dollar weakness driving gold down despite itself. Tell us more about that dollar move.
Yeah, we saw some really significant shifts there. The U.S. dollar actually reached a nearly 4-year low against the euro,
4 years? Wow.
driven by, well, growing concerns over the U.S. government deficit, for one, and just this ongoing uncertainty surrounding major trade agreements. The dollar index actually saw its sixth consecutive month of losses.
Six.
Yeah, positioning it for potentially its worst half-yearly performance since the 1970s.
That's a remarkable streak of weakness. Really something.
It is. And meanwhile, the euro surged to its highest level against the dollar since September 2021. And sterling, the British pound, experienced its largest quarterly increase against the dollar in over 2 years.
So, benefiting from the dollar's broad weakness.
Exactly. And maybe a bit of optimism regarding a potential trade deal between the U.S. and Britain, helping sterling too.
So, with all this action, a weak dollar, shifting commodity prices, strong stocks, what does this all mean for how central banks are thinking interest rates, monetary policy, especially with such strong market signals kind of pushing them?
Yeah, this brings us to a really pivotal point regarding central bank policy expectations. U.S. Treasury yields declined on Monday.
Okay.
And that was fueled by these growing expectations that the Fed might actually accelerate its pace of monetary policy easing this year.
Accelerate, meaning cut rates faster or sooner.
Both, potentially. Fed funds, futures traders, they're now pricing in a substantial 94.6% probability of a rate cut at the September Fed meeting.
Almost a lock then, according to the market.
Yeah. According to the market, yeah. And they're anticipating 66.3 basis points of cuts by the end of the year. So more than 2 standard quarter-point cuts. You can almost feel the market trying to pull those rate cuts forward.
That's a really significant shift in expectations. Is there a specific, maybe less obvious driver behind this accelerated anticipation of Fed cuts, beyond just, general economic data?
There is actually. Part of this comes from the Fed approving a proposal to reform the supplemental leverage ratio, or SLR.
Okay, the SLR, remind us what that is.
Sure. Basically, the SLR dictates how much capital large banks must hold against certain assets, even very low-risk ones like treasuries. Easing these rules, which is what the Fed approved, it's widely anticipated to trigger substantial U.S. Treasury purchases by banks.
Ah, because holding them becomes less capital intensive.
Exactly. Which would inherently put downward pressure on Treasury yields. So you could argue it's maybe a subtle mechanism by the Fed to encourage banks to help finance government borrowing, perhaps without overtly stating it, could impact overall financial stability and market liquidity down the line, too.
So a seemingly technical regulatory change could have a pretty big ripple effect on government funding and bond markets. That's fascinating.
It really is.
And across the Atlantic, how are European central banks signaling their intentions? Are they feeling similar pressure?
Well, Eurozone government bond yields remained relatively stable on Monday. German inflation, which is always a key indicator for the ECB,
Yeah.
actually eased in June, came in at 2.0% year over year.
Right on target.
Right on target. And it slightly surprised analysts. So that modestly increased expectations for ECB easing. It appears the ECB might have a bit more room to consider cuts if inflation continues to moderate like this.
Okay.
And speaking of central bank guidance, we're all looking ahead to key speeches today, right? From figures like ECB President Christine Lagarde and, of course, Fed Chair Jerome Powell.
Always market movers.
Absolutely. Those could certainly move markets and provide, hopefully, further clarity on their thinking. Any hint of a shift in tone or, new economic projections will be heavily scrutinized.
Definitely something to watch today. Okay, now let's turn our attention to the political landscape for a bit. Specifically, the U.S. Senate's major legislative effort right now, President Trump's comprehensive tax cut and spending bill.
Right, the big one.
It cleared a significant procedural hurdle over the weekend, passed with a very narrow 51-49 vote. So what's next for this bill, and why is it drawing so much attention and, frankly, contention?
Well, what's truly fascinating here, I think, is the ongoing debate and the potential for amendments. The floor debate started Monday,
Okay.
and this includes what's known, often dreaded, as a lengthy vote-a-rama.
Ah, yes, the vote-a-rama.
Yeah, essentially a marathon session. Senators can offer and vote on numerous amendments, often goes right through the night into the early morning.
Sounds exhausting.
It is. And while the bill is ultimately still expected to pass, there's this renewed focus on its immense cost.
Right.
And also the unprecedented use of this new current policy baseline cost estimation method.
Right, you mentioned that. How does that work again?
Well, this new method, it essentially doesn't account for costs from sunset provisions in existing policy. So it doesn't factor in things like tax cuts or spending programs that are scheduled to expire under current law.
So it makes the new bill look cheaper.
It makes the new bill appear less expensive than it might otherwise be estimated over the long term, yes. And this accounting change alone has certainly caught the attention of many, really fueling the fiscal debate around the bill.
Yeah, I can see how that new method would be a major point of contention. Definitely complicates the fiscal picture. And it seems there are still areas of friction beyond just the accounting, even within the Republican Party itself.
Oh, absolutely. Fiscal conservatives are voicing opposition. You also have concerns about a specific Senate amendment that could cut federal matching funds for Medicaid in some states.
Which would have real impacts on healthcare funding.
Big impacts. Plus, the proposed rollback of green energy tax credits is stirring significant debate, obviously potentially impacting the clean energy sector. So, with at least 6 major Republican holdouts reported and only 3 votes to spare.
Tight margin.
Very tight. Senate Republican leaders are really struggling, it seems, to gather enough support.
So this raises a critical question then. How will these amendments, the votorama, these internal party dynamics, how will it all play out before President Trump's self-imposed July 4th deadline to sign the bill?
The pressure is immense. Yeah, that deadline is looming. On one potentially positive note for passage, the longstanding dispute over the deduction for state and local taxes. Yeah. SALT.
SALT, right. Always controversial.
Always. That appears to have been resolved, according to reports. Just to quickly clarify for listeners, SALT allows taxpayers to deduct certain state and local taxes from their federal taxable income. Limiting it or restoring it has been a huge battleground in recent tax debates.
So resolving that removes one hurdle, at least.
One less hurdle, exactly. But the overall picture, it definitely remains complex. And it has significant implications for the U.S. economy, for public spending. It just illustrates so clearly how legislative actions directly feed into market sentiment and expectations, even before they become law. Investors are trying to price in potential changes to the tax code or government spending right now.
Absolutely. So, okay. You've heard about the record stock highs largely driven by tech. You've heard about these significant shifts in central bank policy expectations leaning towards easing. And then there's this ongoing political high wire act with the U.S. tax bill.
Lots going on.
Given all these powerful forces at play, market momentum, central bank signals, political maneuvering, how do you think these diverse elements will actually interact and shape the global economy's trajectory in the coming months? Where might the next surprising shift come from? Or maybe what unconsidered factor could emerge as the next big market mover? Something for you to think about. And that's all the time we have for our exploration of today's key market and economic insights. We really hope you found these nuggets of knowledge valuable.
Yeah, thank you for your attention.
You can subscribe to our show if you like it. We'd appreciate that.
See you next time.